So today's topic is ESOPs and term sheets. And the list of sessions lined up. I think we're almost there at the end of the boot camp. We have two more sessions. One is AI buzzword and ChatGPT, and we are planning for one other session on mental health. So I will share the schedule with you all. And here are some Zoom etiquettes before starting our call. Please test your audio and video, and you have a stable internet. Mute your microphones on entry and stay on a video for an interactive session. And during the meeting, please do not speak. If you have any questions, please raise your hands and stay attentive for the session. And let me take some time to introduce our speaker today, Ms. Shilpa Agarwal. Hello, Shilpa. Nice meeting you virtually.
Hi, Sabia. Thank you for having me. I have cold, so please excuse me for my heavy voice.
No, it's okay. It's fine. And I have a brief intro about our speaker today. So Shilpa is a qualified company secretary with 10 years of experience. Her areas of expertise includes advising on ESOPs and fundraising options for startups. And her com other competence include advising on capital structuring, foreign direct investment in India, acquisitions and managing end-to-end corporate secretarial compliances under company law and FIMA. I hope I did your intro well. Over to you, Shilpa. You can carry on with the session now.
Yeah. Thank you, Sabia. Thank you for the introduction. So I would like to share my screen. I have prepared a brief presentation on ESOPs and term sheet.
Sure. I made you post. You would be easily sharing this. Yeah, it's visible.
Yeah. Okay. So is my screen visible?
Yes, sure.
Yeah, I think you can mute everybody.
Yes. I did.
Yeah. So welcome all. We have a 2 hour session on ESOPs and term sheets. In these 2 hours, I will try to cover as much as possible. My objective is by the end of this session, at least you should have a understanding of what is ESOPs and how they work, how are they useful to the promoter, to the investors, to your employees, and the same thing with the term sheets. So I'm here to give you a brief understanding on both these topics. Both the topics I feel from a promoter standpoint are very important and relevant because ESOPs and term sheets, these are widely used in your startup journey from the beginning. So I'll take you briefly. We'll start first with ESOPs. In case you have any questions you can raise the same at the end of the slide, or after the end of each topic we can have a Q&A round. So anything is okay. ESOPs. I'll first tell you what is ESOP. Employee stock option. That is, it is nothing but an company is giving an option to the employee. You are not giving the shares. So that is the basic difference. That you are not giving shares, but you are giving option that the employees can get shares at a future date, and the price at a price that you are fixing today. So basically, the employees, he'll get an option, not a certificate, but an option that tomorrow on meeting so and so conditions, I'll be granted so and so number of shares on payment of so and so price. The price is generally, very less or at a discount to your fair value. So that is basically employee stock options. That is the meaning of employee stock options. And then there are eligibility criteria that to whom employee stock options can be granted. You can grant ESOPs to your directors, to your officers, and employees. Employees, again, you have a definition. You cannot grant it to anybody. You can only grant only to directors, officers, employees of course, of your. Yeah, I think someone has a question.
Yeah. So sorry. Hi Shilpa. Thank you
Yeah.
so much for talking about this topic. I think it's a very interesting one. So for the eligibility, can you also explain a little more on when we say employees? Because I have a question regarding to if we have say consultants or if we have advisors. So
My next slide is on that.
okay, so then probably yeah. Okay, all right. Thank you. Yeah.
So I am coming to that. I know that is a very important question, and because I have been dealing with this for quite few years, so the common questions that the startups founders usually have, that I'll try to cover by myself. I was coming to that slide. I'll just finish this and then I'll go there. So as I was saying, ESOPs you can grant not just to employees of your company, but you can grant stock options of your company to the employees of your holding company and of your subsidiary companies as well. So there is, just by passing a resolution, you can grant your stock options to your holding and subsidiary companies. Now coming to employees. So here employees are categorically defined, like to what kind of employees you can issue stock options. So only your permanent employees. Permanent employees. Sorry, someone has any question? Okay.
I think it was the basic unmute. It's okay. You can carry on.
Okay. So permanent employees who are on your payrolls as permanent employees, only those employees are eligible for ESOPs. Your advisors, your consultants are not eligible. One who is not on your payroll as an employee is not eligible for ESOPs. Because startups usually onboard many consultants and advisors, and offer them I make an arrangement with them that some shares will be granted to them, but to them we cannot grant ESOP. For granting of ESOP, the basic eligibility requirement is that he should be on payrolls of your company as a permanent employee. And a director also, a whole-time director can be granted ESOPs, but of course here, out of the directors list, independent directors are excluded. Person who is a promoter or belonging to a promoter group is also excluded. Of course, if you are a startup, if you are registered as a startup with DPIIT, then you have been given an exemption to grant ESOPs to your promoters till you have this startup registration. Means up to the period of 10 years from your incorporation, you have an exemption to grant ESOPs to your promoters and directors who are holding more than 10% directly or indirectly. Otherwise, for other than startups, they are not eligible. So this is also one of the important points from a startup point of view, because we see in many when a company goes for fundraising round, the promoter reserves a certain portion of shares as ESOP to himself. So that is possible only if you are registered as a startup. Otherwise, you are not eligible for ESOP. So this is the definition of employees, only your permanent employees and whole-time directors, except independent directors. But promoters and directors holding 10% are eligible if you are a startup. So what are the benefits of ESOP? Why a company should...
Shilpa, sorry to interrupt. There is one comment message in the comment box
Yes.
saying, could you please elaborate on the promoters?
Promoters are the ones, you mean to say who is categorized as promoter? Then promoter is one whose name is mentioned in the memorandum, or who was fundamental in incorporation of the company, or when you file your annual return every year, a company has to do certain annual filings and balance sheet. So in annual return, you will classify certain persons as promoters. Specifically, you will write their names that these are the promoters of the company. So those people are the promoters. Basically, the founders are the promoters. I hope I am clear.
Yes, thank you.
Yeah. Okay. So we'll go to the next slide. So benefits of ESOP, why a company should, first place, why it should issue ESOP. So it helps in attracting, rewarding, motivating, and retaining employees. So because we know startups usually have cash crunch at the initial stages. So they kind of bundle ESOPs along with salary component to make it attractive, and also uh, help you in getting good talent from the market, and they will also be motivated that we are part of the company's journey, and if a company grows they will grow along with it because they have stock options, not shares in today but which can be converted into shares tomorrow. And it enhances their job satisfaction. It helps in wealth creation because when a company grows its value may grow multiple times. So with that it may help them in creating wealth, and it acts as a retirement benefit plan. It helps employee align with company's goals and objectives. So when they are granted ESOP, they feel part of the company, and they can grow along with the company. So they are also kind of aligned with the company's goals, and they have a kind of motivation to work better for the company. These are some terms that are generally used. Give a brief in definition for each of these so that in next slides when we use them we are clear on that. Employee stock option scheme or plan. So usually to implement ESOPs, we prepare an ESOP plan, and that plan will will cover all the terms and conditions for granting the ESOPs, and what is the vesting period, how exercise will happen, what are the what all rights are available to ESOP holders till they are converted into shareholders. All those things will be granted. This will be kind of a Bible. It's a Bible for ESOP. Like a company will have articles, ESOPs will have a ESOP plan or ESOP scheme. Then next thing is granting. The process by which we issue them these options, or we issue them this ESOPs is called grant. So these are the technical terms under ESOP. Grant is when we are issuing them stock options, we say we are granting them ESOPs. Vesting is the time period after the options are granted, during which these granted options can be converted into shares. So there are three stages basically in ESOP. First is granting, second is vesting, and third and final stage is exercise. So first when we are issuing them options, that is grant stage. Second, there will be a certain gap between grant and vesting period, which is a statutory time limit of one year. So by no way we can reduce this time period because it is under the law that there has to be a minimum gap of 1 year between granting and vesting. So there is this lock-in of 1 year after granting, and then starts the vesting period. So after granting, the vesting period starts, and vesting period they are eligible to exercise the options. Of course, there will be a vesting schedule, like some companies may say that every year 25% of the options will vest, or every year or 10% options will vest. You can have different vesting schedules for different kind of employees, because you may grant ESOP to different level of employees, and not every body will have the same vesting schedule or same vesting period. So it can be different for different kind of employees. So that is the vesting second stage, and then the final stage is exercise. Exercise is when the employee finally decides. We have to note that by granting ESOP, an employee is not compelled, that it is not mandated that he has to exercise and get the share. It is just an option. Excuse me. It is just an option that we are giving him. It is completely his choice whether he wants to exercise or he doesn't want to exercise. There is no compulsion on him. So when he finally decides that he wants to exercise, he has to pay an exercise price, whatever price is decided at the time the options are granted. So he has to pay that small price and get the share. So that is called as final exercise. exercise price, the price payable by the employee at the time of exercise of options. So these are the three stages in the life cycle of ESOP. We'll go to the next slide. So now process for issue of ESOP. If anybody has any questions in the life cycle of ESOP, please let me know.
Shilpa, you'll take the questions at the end of the session, or you want to take any time?
No, if you have any difficulty in understanding the basics, then I will cover there. Otherwise, we can cover at the end. Okay. So we will cover at the end. So now process for issue of ESOP. So first comes the decision making part, and then the implementation part. And any kind of thing which we want to undertake, first we will do brainstorming and deciding on important points, and then how we will implement it. This decision making, you have to decide that how much quantum of options you want to grant and what is the mode of implementation. We'll cover this mode in detail in the next slides. There are two modes of implementation, direct and through trust. So we'll go to them next. And you have to upfront decide that how many number of shares or how much percentage you want to set aside for ESOP, because that has to be clearly mentioned in your ESOP plan and in your resolutions. It cannot be like I'm fixing I'm just fixing 500 today, and tomorrow I'll grant 1,000 options. It cannot be like that. We have to set aside a pool, and then you can grant only within that pool. Then next, you have to determine the eligibility of employees and criteria for grant of options. It is purely your internal work. There are no statutory requirement that which level of employees or what category of employees are eligible. Only permanent employees are eligible. That is the only rule. Within your permanent employees, to which employee you are granting how many options, and how is the vesting period, how is the vesting schedule, is purely board of directors decision to implement the ESOP policy, to decide on the ESOP grants. Then again, as I said, vesting period, exercise price, exercise period. So all these things have to be decided in the ESOP plan. Actually, there is one ESOP plan in the first that is common for all your ESOP options that you grant under that ESOP policy. After that ESOP plan, we have an options agreement that is individual to the employee. Like I'm granting 100 stock options to employee A. So when I'm granting him options to employee A, I will execute an options agreement with him, the company, and Mr. A specifically. So that options agreement will have all the details relating to his options, Mr. A, because as I said, we can have different vesting period for different people. So in that options agreement, I will write all the details, like, this is your vesting schedule, this is your exercise price, and these many options have been granted to you, and you can exercise on so and so timeline. And certain important clauses also in the options agreement will include, like right of first refusal, and some restrictions on transfer, because tomorrow it's a private company. You would always like to have a control on your shareholding, or who becomes your shareholder. So options agreement is an individual agreement that we will execute with each employee to whom options are granted. And ESOP is one common policy for all options. Then treatment of options in case of separations. This is like when you have mergers, acquisitions, these options will get adjusted based on accounting treatments. Then finally we have to do the implementation. Once we have decided on all these points, then we will prepare an ESOP policy. We will adopt the ESOP policy based on, we will take members approval, board approval, members approval, and adopt the ESOP policy. Then we will grant options to eligible employees. Then options will vest as per the vesting schedule given in the options agreement. Then employee will exercise the right, and finally company will allot the shares. So that is how a stock option holder will become a shareholder. This is employee stock options. ESOP is one of the employee incentive schemes there are other employee incentive schemes also. Today, of course, our session is purely on ESOP, but I will just give a one-liner on, other employee incentive schemes that are also available in the market. Of course, ESOP is the most widely used and prevalent schemes among the startups. As I told you, ESOP, it's only an option. It's a right but not obligation to given to employees for purchasing shares of a company at a future date at a predetermined price. That is ESOP. Then we have employee stock purchase scheme. Here in this scheme, employees are usually given a discount to your current fair market value. There is no option. You are directly giving them the right to purchase the shares at a discount to your fair market value. Usually, it goes as a part of IPO. If we see any IPO, there is some employee quota reserved for employees, at a discount to the fair market value, the current fair market value. So that is employee stock purchase scheme. Then we have another scheme, restricted stock units. Here also you have a right to receive shares at predetermined price on occurrence or fulfillment of specified conditions. So there might be some performance milestones or other conditions put in place for the employees to achieve those conditions, and then they can get those shares. Then we have stock appreciation rights also. Stock appreciation rights also, you must have heard about it. Phantom stocks, I think they are very prevalent among the listed companies. So stock appreciation right is nothing but employee gets the benefit in the form of cash or equity equal to the difference between price of share on the date of I'm giving the grant and the price of share on the date of exercise. It is basically nothing, is only stock appreciation rights are given. If I'm granting the rights today, and today my value is say 100 rupees, and on exercise my value is 500. So 500 minus 100, 400 rupees will be given to the employees either in the form of cash or in the form of shares. When they are given in the form of cash, it is called as phantom stocks. So phantom stocks are nothing but a kind of stock appreciation rights only, but they are always settled in cash. So there are no shares that are issued on exercise. It is basically the difference between your fair value on the date of exercise and on the date of grant. So that is being given as your cash.
Shilpa, there are a few questions in the chat box. One is, what makes the distinction between whole-time and independent directors?
Okay.
And the other question is, what happens if the employee leaves before the vesting period?
Okay. Yeah. So first question, what is the difference between a whole-time director and independent director? So as the name itself suggests, whole-time director is a person who is involved in day-to-day affairs of the company. Okay. His full time is reserved for the company. You appoint him as specifically as a whole time director. You are paying him salary or remuneration, and he's involved in day to day operations, full time for the company. Whereas independent director, his role is he's not involved in your day to day management or affairs of the company. His role is his role is only to attend board meetings and to keep a tab on the company's progress and company's compliance, whether the company is going as per its agreed business plan. So it's a supervisory role. It is not he is not involved in day to day operations of the company. He is independent of the board. He is not related to the board also. There are certain qualifications, criteria that has to be met for a person to be qualified as independent director. And nowadays he has to he has to be registered under an MCA data bank also as an independent director. So he is completely independent of the board of the company. He is a third party and an outsider brought into the company to keep an eye on on the affairs of the company. Mostly relevant in case of listed companies. Private companies do not usually appoint independent directors. Usually, when there is a listed company, you have a compulsory requirement of appointing an independent director. Your investor director cannot be called as independent director, because investor director has an interest in the company. He is appointed on behalf of somebody who is holding shares in the company. So he is not an independent director. And the second question was, sorry, Sabia, I mixed with the second question. Vesting, yeah. What happens if the employee resigns before vesting? Yeah. So those terms are very clearly defined in the ESOP policy. Like what happens if an employee dies during the vesting period, after the vesting period, before the vesting period. What happens if an employee is terminated due to some misconduct? What happens if an employee resigns? All these things will be very clearly defined in the ESOP plan. You and company has complete liberty to decide how you want to frame your ESOP policy. Usually what companies prescribe is before vesting period, before the vesting even starts. Like as I told you, there is a 1 year gap between grant and vesting. During that period, if an employee resigns, so the options that are granted to him will lapse. And if he resigns after the vesting, during the vesting period, once the vesting period starts, and what then he resigns, then whatever options are vested to him during that period, that the company may give him an option to exercise within 3 months or 6 months. If he doesn't exercise, then even those will lapse. And then you can even insert a clause that if the employee joins a competitor company, then in that case, even the vested options which are vested to him and he resigns during the vesting period, that also will lapse. So you have complete liberty to frame all these clauses in the ESOP policy. And then you can even add one more clause saying that the board will have a right to change on case to case basis. That is also allowed. Yeah. Okay. So shall we proceed? Okay. So modes of implementation. There are two modes of implementation. One is direct route and the second is trust route. Of course, among the startups, direct route is most common. It's easy and hassle-free mode. Very simple. Company will grant options to employee. Employee, if he chooses to exercise, he will choose exercise, and company will allot share. So this is simple route for granting of ESOP. Then we have a trust route. Trust route is basically followed by large companies, which would have large number of ESOPs, and because when an employee exercises, he'll be allotted share. So then there will be day-to-day changes in the share capital, or there will be day-to-day dilution. To avoid that, what the company will do is company will set up a trust, an ESOP trust, and then it will allot shares to the trust, and then this trust will in turn do the grants to the employees, and when the employee exercises, the shares will be transferred to the employees from the trust. So there is no effect on the balance sheet of the company, uh, on the share capital. Only the trust will be a shareholder, and tomorrow when it exercises, the same number of shares will be transferred to the employee, but there will be no other dilution. Uh, uh, just covering in brief, for this the trust, because it is set up by the company will only grab first step. Company will provide loan to trust to acquire shares, and then company will issue shares to this trust. Then this trust will issue options to employees. Employee exercises right to acquire this share. So when employee exercises, the trust will transfer shares to the employee, and when the employee pays the exercise price, trust will repay the loan to the company. So this is a small life cycle of trust. A little complicated structure, involves increase compliances, Companies Act and taxation wise also. Not advisable for startups. Okay, now we will cover the regulatory framework and valuation governing around ESOPs under Companies Act, Income Tax, and FEMA. I am not covering SEBI because that is applicable only if you are a listed company. Companies Act, the procedure is simple. First, you have to take board's approval, then shareholders' approval. Private company, so only ordinary resolution will suffice. And in your EGM notice, explanatory statement, you have to include disclosures, what all are required as per Companies Act. And then after the shareholders approval, board will grant options. There is a gap of 1 year between grant and vesting. After granting, there will be vesting, final exercise, and then allotment of shares. So this is the brief procedure under Companies Act. Companies Act, other points?
Shilpa, we have one more question. Sorry to
Yeah.
interrupt you in between. I was
No
waiting for the
problem.
slide to be complete. There is a question from Vijay. He's asking what makes the trust body? Who can be the part of it?
Trustee, you mean to say trustee? See, for listed companies, there are specified rules that if your company is providing loan to the trust, then your directors or your KMPs cannot be the trustees of the trust that has been set up for employees. Somebody else has to be set up. But if yours is a private company, and then if your company is not providing loan but the promoters are providing loan to the trust, then your directors can also act as trustee for the trust, because trust will not have money on its own. It has been set up specifically for this ESOP, employee incentive schemes. You can have other schemes also under the trust. So it needs money to acquire shares from the company. So that money has to be funded. It has to be funded either by the company or by the promoters or from a third party. If a company is funding, then its directors cannot be the trustee. But if promoters are funding, then the directors can be the trustee. Yeah. Okay. So under Companies Act, we have to ensure that, in case you are going to grant more than 1% of your issued capital as ESOP to any specific employees, then you need to take a separate resolution, separate approval from members for that purpose. And once you have adopted an ESOP policy, every year in the director's report, some disclosures are must. This point is overlooked by many startups. We see many directors report that though the company has an ESOP policy, but the relevant disclosures as required in the director's report are not provided. Very basic, but we have to ensure that these disclosures are provided in the director's report every year once you have adopted ESOP policy and started doing the granting. ESOP register should be maintained, and accounting and valuation for ESOP shall be as per ICAI guidelines. Accounting standards have to be followed. Now coming to the most important point for any topic, income tax. So these ESOPs, it might have sounded good till now, but now here comes the real picture. There is income tax on ESOPs as well, and huge income tax. So coming to the employees, it might look as a double taxation, but when I will show you the calculation, it may not look as double taxation. So employees are taxed at 2 stages for ESOP. First is perquisite tax, that is when an employee exercises the options and gets the shares. Please make note, there is no income tax on grant of ESOPs. There is no income tax at the first stage. The income tax comes into picture only at the final stage, that is exercise, because ESOP is purely a option. It's his right but not obligation. If he doesn't exercise, there is no taxation. But if the employee chooses to exercise his right and gets shares and he has paid the exercise price, he has got the shares, at that time there is taxation. Taxation is not on what value. So difference between what is the fair value of the company on the date of exercise minus what price he has paid. So whatever is the difference, that is treated as perquisites, added to his salary as perquisites, and he will be taxed based on his applicable slab rates. So that is one big taxation on ESOPs, because there might be a huge difference between the exercise price and the fair value of the company on the date of exercise. But that is how it is, that tax has to be paid. Of course, for startups, some benefits are given in the form of postponing the payment of taxes. Not there is no exemption given for avoiding the taxes, but you can only postpone up to a period of 4 years, till either you sell the shares or you resign the company, or till the date of 4 years from the exercise, you can, postpone the payment of this taxes. But there is no avoiding this taxes, they have to be paid. And second is capital gains. Capital gains is when after acquiring the shares, when you want to transfer this shares, I mean sell this shares. So when you are selling the shares, there will be capital gains, which is your consideration minus cost of acquisition, what price you paid to get the shares. Here the consideration less what price you have paid to get the shares will not be your actual price, but it will be the fair value on the date of exercise. Because if you remember, we have already paid taxes at the first stage, perquisites tax, for the benefit that we got, uh, you know, that we got in acquiring the shares at a lesser price. We have already paid taxes. So government is saying, okay, so now during calculating capital gains, for cost of acquisition, you don't consider what you actually paid, but you consider the fair value on the date of exercise. That will be your cost of acquisition. So that way your capital gains will be reduced. So these are the two taxation on employee. One is perquisite taxation and second is capital gains. So somebody might ask, then why would an employee even exercise the options? And there is such heavy taxation for somebody who is in 30% bracket. He will have capital gains will be 15%, but perquisite tax will be straight away 30%. Then why would he even choose to exercise the options? So the thing is that is there, but what happens is usually the exercise is linked to liquidity. The employee will exercise only when he sees a liquidity event in front of him, like when there is a strategic buyer who is buying the company, or when a company goes for IPO. So when it lists, it will have the prices will go up, and he can sell the share. He can acquire at the same time and then sell at the same time, so that he gets actual benefit to pay taxes. Otherwise, if he exercises today and holds the shares for selling in after 5 to 10 years, then it will be an unnecessary tax burden on him for something that he has not got in hand. When he is exercising, he is getting only shares, no cash. But when he sells those shares, he will get actual cash. So usually, employees see that the exercise happens only when there is some sure assurance that today I can exercise and tomorrow I can transfer this share, so that I can get some benefit and then pay in taxes. So that is on employee taxation. On to employer, of course, there is no tax on issue or exercise of options. In fact, option cost to be accounted as compensation expense and allowed as deduction. So every year, once the vesting starts, employer will calculate compensation cost as per the accounting standards that are prevalent, and take it as an expense in his profit and loss account. This is just what I explained. Perquisite tax, difference between exercise price and fair market value on the date of exercise, shall be taxed in the hands of employee as perquisite. Capital gains shall be levied at the time of sale of shares on the difference between sale consideration and fair market value on the date of allotment of shares. Then valuation. So once a company has granted ESOP, excuse me. So once a company has adopted ESOP policy and started doing the grant, so after that every year it has to do a valuation of its shares for two purposes. One is to ascertain compensation cost. As I said, it can ascertain compensation cost and take it as an expense in its P&L account. So for that purpose, and second is in case any employee exercises during that period, so for them to ascertain a perquisite tax, to calculate what is the perquisite tax payable by the employee. So valuation, it has to be for accounting and for taxation purpose. Methods of valuation, there are two methods: intrinsic value method, which is an old method, and then nowadays fair value method is widely used, where many things following are considered for determining valuation, like expected life, exercise price, fair value, expected volatility of share price. All these factors are considered before calculating the valuation. The valuer will do this exercise under FEMA. So yeah, you might have employees outside India also. So you can issue ESOPs to them also, your employees or your directors. Or as I said, you can issue ESOP to your employees and directors of your holding company and subsidiary companies also, whether in India or outside India. So ESOPs can be issued to your to people resident outside India also. Of course, ensure these are the things. ESOP scheme should be in compliance of Companies Act. Sectoral caps have to be complied with. If there is a certain restriction on FDI in the sector in which you are operating, then that has to be complied with. We cannot go override that. And in case government approval is required for your category of business, then that same should be obtained before granting ESOPs to employees outside India. And there is a specific form ESOP, that has to be filed once you do the grant of ESOP to employees outside India within 30 days from the date of issue. Yeah. Now, important thing again, exit mechanism. That what are the exit mechanisms available to an employee once the ESOPs are granted? So the most prevalent one is IPO. Because under IPO, to the employees there are no lock-in restrictions. Like you must know that when a company goes for IPO, entire pre-issue capital is locked in for certain time, 3 months to 6 months. But exemption is provided to employees who have been granted shares pursuant to employee stock option scheme. So that will help them to reap listing gains on listing of the shares of the company. So IPO is the most prevalent way of exit to the employees. Second is buyback by the company. The company, if it has good reserves, cash reserves in hand, so at that time the company itself can buy back the shares or options that are granted to the employees. Third is buyback by the promoter. So not the company, but the promoter can also sometimes individually, personally provide exit to the employees. Then sale to third party, the strategic sale, the company itself is getting acquired by the third party. At that time, there can be sale by the employees as well, because these are private company shares, so these are not freely tradable. So there has to be a proper exit for the employees. These are some of the most commonly used exit modes. Yeah. So with this, I think okay. Yeah. So we are on time. I think with this, I complete my ESOP presentation. Now we are open to Q&A round. If any of you have any kind of questions, you are free to ask. I'll try to answer them, as much as possible.
Please unmute yourself. If you have any questions, you can directly ask.
So Shilpa, quickly, on the very first thing about the vesting and the exercise period, right? So let's say, as you described, so let's say some employees granted 100 shares and every quarter over the 4 years. So in the first year, he or she gets 25% of the shares, that's 25 shares. So on that vesting and exercise period, so is the employee supposed to pay for those 25 shares, or that will keep rolling?
Sorry, you mean taxes?
No,
No, it is vesting. Vesting in the sense, he is not getting 25 shares. He is vesting in the sense he is now eligible to get those 25 shares. Right now, what he has in hand, 100 are granted to him. But after the end of first year, as you said, at the end of every year till 4 years, 25% will vest. So at the end of first year, 25 options have been vested. So now he is eligible today to exercise these 25 shares. At the end of the first year, he doesn't have shares. He has only options. Though 100 are granted to him, but at the end of first year, he is eligible to exercise only 25. At the end of second year, he will be eligible to exercise 25 plus 25, 50. At the end of third year, 75. At the end of 4 year, 100. So though 100 are granted to him on day 1, but the eligibility to exercise this 100 he will get at the end of 4 years.
Right. So my question was, when I get those 25 shares at the end of the first year, 25 options at the end of the first year, so is employee supposed to pay for those 25 options and convert them into shares, or they'll roll into? It's just that I get the.
Yeah. So from that year, it's his decision. If he wants to exercise, he has to pay exercise price and get those shares. If he doesn't exercise, they will get on, keep on rolling, because we will prescribe a maximum period, like for a period of 5 years, 10 years, or whatever, that is your choice. From the date of granting till that time, they can hold those options and they can exercise. If they don't exercise within that period, it will lapse.
Okay. And just a clarificatory question. You said perquisite tax is 30%?
I mean, not 30%. It will be as per their income tax slab rate.
Oh.
It will get added to their salary as perquisite. Whatever benefit they are getting, difference between the fair value minus the exercise price is the benefit that he has got. So that will be added to his salary as perquisite, and they'll be taxed as per their income tax slab rate. I just give an example that somebody who is in 30% bracket, he will have a straight 30% tax on it. Yeah.
Okay. So one last question from me is since some of us start companies outside India for a variety of reasons, let's say predominantly in US market, and let's say the holding companies in US. So how do we extend those stock options to Indian employees? Because most of the employees are based in India.
So now that is a different thing. See, you want to issue options of your US company to employees in India. Then your US laws will be applicable, not your Indian laws. When your Indian company wants to issue its shares to employees outside India, then Indian laws will be applicable. But what you are asking is your company in US, which is a holding company, wants to issue its shares to employees in India, then you have to check the laws that are applicable in US for Indian employees and also the taxation component. But that will not fall under company law of India.
Okay, so can you throw some light, or is it out of subject?
Yeah, that is out of syllabus for me. Yeah.
Okay, thank you so much.
Yeah.
Hey, Shilpa, hi. So I have two specific questions. One, so what's the difference between ESOPs and equity/stake in an organization?
Okay. Shall I take for one by one?
Yeah.
Yeah. So difference between ESOPs and equity share, very good question. ESOP does not form part of your share capital till the options are converted into shares. It is only a part of your diluted capital. But if you see your balance sheet assets, equity share capital, only your shareholders who have got the shares and who do not hold any rights. Options are just the rights that you have given. They are until the date they are exercised, they do not form part of your share capital. But of course, so there is no dilution as such. But many times your investors and all will request for diluted shareholding pattern. At that time, you have to include ESOP. But as such, strictly, they do not form part of your share capital.
Okay, got it. And second thing, so technically we all understand what ESOPs are and what are they going to do. But in a practical world, in a startup ecosystem, how do you convince the employees to, or how do you entice them? Because ESOPs are, stock options are something which is very long drawn. I probably would have started the company today, and if I try to get a senior resource, with some stock options for the employee, for him to really see value, it has to be either an IP route or funding route or some investor who has to come in, which is going to take some time. So, I mean, how do we really, what's the real benefit of ESOPs?
Yeah. 1 minute. So yes, as you mentioned, ESOPs are a bit long drawn. So how do we convince them in creating, value? Is a very simple thing that somebody who has a long term objective with the company, as you said, he has to be aligned with the company's goals and objectives. ESOP will not reap profits in 1 or 2 years, except if you are, already on your growth story. There are some stages in a startup life cycle as well. If you are at a very ideation stage, at a just a started stage, it will take some time. So somebody who is getting associated with the company, uh, uh, they have to believe in your in your idea, or in the in the value that you are going to create. Only then they can be part of the journey. Somebody with long term objective only can be, you know uh, interested in getting ESOP, because that will, of course, they will lose their part of, because ESOPs are usually bundled with salary component. So they might forego a part of their salary in the initial stages, but they have to be, when they see the long term benefits, which will help them in wealth creation when the value of the company increases multifold times. So that has to be, through your projections or whatever business plan you create. Uh, when you go to an investor, that these are my projections and this is how I plan to grow. So all those things also have to be put to, senior, when you take somebody at a senior role, to get their confidence that yeah, the company can scale up, it can reach the value that you are promising, so that he gets on board the company.
Okay, thanks.
Anybody else?
Just to add to Shiva's whatever question that he had, maybe when he is looking for the what do you call resource, uh, maybe a tech co-founder or somebody, rather than going for only looking at the ESOPs option, which may not be feasible for them, they can look for something of end co-foundership, maybe something like there is an agreement which on the basis of some milestone, be it revenue, be it number of customers, or be it any other milestone that works for the startup. They can have kind of end co-foundership agreement, wherein the what do you call the shareholding would be given based on the milestones that the guy is going to achieve. Because ESOPs are typically for the employees, not for the people who are on the top, beat the what do you call directors or the next level to the directors in the company.
That model can also be taken up. So that is nothing but a direct transfer of shares. So tomorrow, then who will transfer the shares? The promoter himself has to transfer the shares. If the promoter is willing to dilute his shareholding, then you can look at those options. Or if you want to do an issue from the company, then again the same taxation rules will apply. If he is granted shares at less than fair value, again income tax will come into picture. It will be income from other sources for him. And if he's paid at the fair value, then why will he acquire shares by paying a fair value? So all those things are, I mean, if it is not an employee, if it is not an ESOP, then the company has to do, it can do only two modes of funding. Uh, issue options in issue shares in only two ways: either rights issue or private placement. Rights issue is only to existing shareholders, where valuation do not apply. Whereas if you go for private placement of preferential allotment, then you need a valuation report, and then you cannot issue shares at less than that price. So why would he pay that much price and get shares?
Shilpa, just to what do you call clarify from my side, I mean, like, can't the founder have an agreement to issue shares at later in point time at a specified price to a specified guy? who is part of the what you call overall management team by what you call agreeing through an agreement rather than looking at the valuations from the valuation point of view. Maybe the taxation issues I do understand, but leaving the taxation issues apart, for example, if the company is able to get next 5,000 customers or 10,000 customers, okay, on that achievement of 10,000 customers, the chief marketing officer would get the shares at a say market price less 30% or 40% on that date.
You can execute an agreement, but in what mechanism under Companies Act will you issue him shares? You cannot say, or if you can issue, you can undergo valuation and issue him shares for consideration other than cash. Then by putting this agreement in support and performing valuation that he has generated me so and so revenue against that, and I am issuing him shares. So that will be issue of shares for consideration other than cash. So that mode can be looked at in that angle.
Got it. And also, ESOPs are for the employees. Okay, what if tomorrow, see, founders has less stake, the founders has minimal stake in the company because of the too many funding rounds the guys have raised? How would the promoters get the something like ESOPs? Would there is an option to promoters to get something to increase his stake or her stake in the company?
So that I covered that, if you are registered as a startup, then the promoters are eligible for ESOP. For other than startups, they are not eligible. But if you are a startup, then you can grant ESOPs to your promoters.
Hi, ma'am. What is the basic difference between ESOPs and earned co-foundership? Assuming we would like to give some stake to co-founders for an encouragement, right? So while bringing them on board, the co-founders, giving, as someone was suggesting, that ESOPs is a long game. Encouraging them to play on ESOPs would be a little difficult. So earned co-foundership.
I'm sorry, I missed you in between.
Yeah. So, so there is a term called earned co-foundership.
Yeah.
What is the basic difference between ESOPs and earned co-foundership?
Yeah. So earned co-foundership, there also you will see co-founders may come from different kind of background. Somebody may bring the base initial money or corpus that is required for starting the company. Somebody might bring the technical skills, what is required for setting up the beginning, for setting up the business. Somebody might be marketing and sales expert. So co-founders can be from different background, and somebody who is not bringing money to them, earned co-foundership is where you in terms of the in lieu of the services that they are providing, you would offer him shares. So just as I answered previously, if you can value what quantify what he has provided to the company in monetary terms, then you can grant him shares against that quantification. But where you cannot quantify, at that time it is better to always offer ESOP, where
So
property. Yeah.
So can we bring the terms of ESOPs onto the earn co-foundership? For example, like we bring earn co-founders onto the table, and then can we write the policy in such a way that attaining to certain milestone, I mean, we exercise. I mean, we give an option of attaining to a certain milestones, and then after that we could give them certain amount of shares to get exercised, so on and so forth. That can we merge both of the terms into the policy and then give that policy to the one co-founder? Is that possible under the Companies Act?
So as I told you, Companies Act doesn't have any restrictions on how the vesting will happen and what are the milestones for vesting. So I think so it is possible. But if I have to confirm, then I can confirm you post this meeting after being 100% sure. Yeah.
Yeah. Thank you.
Yeah.
Do we have any more questions coming in?
I know the basic difference between ESOPs and ESPPs.
Yeah. So ESPS, ESOP is Employee Stock Option Plan. ESPS, Employee Stock Purchase Scheme. So as ESOP has different cycles, there is no such thing in Employee Stock Purchase Scheme. You are directly giving employees an option to buy shares directly at a price lesser than your whatever price, your fair value. That is, it usually goes as part of your IPO. There is certain employee stock purchase scheme, certain employee quota reserve that you are giving a certain discount at the current fair value. So that is the basic difference. All this stock option plan has different cycles, and it is a option. It's an option. But their stock purchase scheme, you are directly giving here, you stock options are granted and then tomorrow they'll convert into shares. Whereas employee stock purchase scheme, you are directly giving them an option to purchase shares.
Great. Shilpa, if you could throw some light on what I call, instead of allocating the shares, something like phantom stocks, wherein there will not be any allocation of shares, it's only the difference in terms of the what you call, whatever increase in the price that will be given to the employee, instead of allocating or diluting the stake in the company. Would you be able to throw some light on this?
Okay. So in very brief, as I said, phantom stock is nothing but there also a policy has to be put in place that these are the milestones, and as somebody was for earned co-foundership, you said certain milestones have to be achieved. If we can bundle up that thing, that on achievement of certain milestones, certain shares will be allotted. So in phantom stocks also you can prescribe like that, on meeting certain milestones. So whatever is the fair value on the date of that, achieving those milestones or meeting those conditions, less today I'm giving you this right, that today I'm saying that in 6 months, if you fulfill this criteria or if you achieve these targets, then I'll give you phantom stocks or cash, whatever phantom stocks if we say. So within 6 months, 6 months later, if you were able to meet those milestones, then whatever is the value of the company post 6 months minus whatever is the value today, the difference in the value of the company will be paid to him in the form of cash. Of course, star mark taxation applies.
Got it. What kind of agreements do people have to enter in such case? Whether India permits the phantom stocks?
Yes, it is permitted. I would say it is not prohibited. So we assume it is permitted. There is, if you ask me in law, is there is a term called phantom stock defined? Then no, there is no term called phantom stock defined under Companies Act or any other law. Even SEBI also, for listed company also, it is allowed because when finally shares are allotted, only then certain regulations and rules apply. But here, when the settlement is happening in the form of cash, at that time, no rules and regulations are as such applicable, because anyhow when you are paying cash, the taxes automatically apply. So as long as income tax is there, they are all happy, the regulators.
Got it. Thank you.
I think we are done with the questions, Shilpa.
Okay. So thank you. That was our session on ESOP. Next, we have term sheets. I think ESOP was more wider than term sheet. Term sheet, I don't think we may need to go into that depth. But okay, from my side, I'll try to cover to the maximum extent possible. Okay. So now term sheet. So what is a term sheet basically? Is it legally binding or not? Uh, so just by definition, term sheet is a non-binding document. So star important point is that term sheet is a non-binding document. It is not a legal document, and tomorrow neither your investor nor you can force uh, exercise or implementation of what is mentioned in the term sheet. Though you might have signed, investor might have signed, it is just an understanding of the terms that will govern the investment in your company, but it is purely a non-binding document. If you have a chance, whenever you execute a term sheet, in the first line itself it will be mentioned that this is a non-binding document. This is just a general understanding of the terms and conditions for a proposed investment by an investor in the company. So when even before the investor is onboarded, we may have a term sheet that these are my conditions. Sometimes the investor gives the term sheet, sometimes the company prepares a term sheet that these are my conditions on which I want to take the investment. Sometimes the investor gives these conditions that these are my conditions on which I want to invest in the company. So this, it is basically an understanding of your terms and conditions for the proposed investment. So that is a term sheet. And why is it required at the first place? Why can the investor not directly put in the money or company directly issue shares? Why a term sheet is itself required in the first place? Then first, it provides clarity, because you might have, the founders might have something in mind, the investors might have something else in the mind. So it provides clear clarity to the founders and the investors on key terms, such as how the control will remain after their investment, what are the exit strategies, who will cover the day-to-day operations of the company, who will manage, what are the rights that are available to the investor after their investment. On all of these things, there will be a clear cut clarity to the investor and the founder by way of execution of term sheet. And second is efficiency. It resolves major points early, streamlining the deal process. So when you have put it in the when you put it down on paper, it will help you negotiate and resolve your major concerns and do those negotiations early on itself, so that tomorrow when we execute the actual document, which is shareholders agreement, or if it is a secondary sale, then share purchase agreement, at that time we do not have any complications, or we can save the time. So all your major points and major negotiations can happen on early. Like the founder may not be willing to offer a board seat, but the investor is looking for a board seat. So what all? Then finally you decide on board observer. Whatever that, those kind of negotiations can finally happen at the term sheet level itself. Next is risk mitigation. It sets clear expectations upfront, reducing the risk of disputes. All these points mean the same thing. I mean, it is just put in different modes. So, when, as I said, when you have clearly written everything on paper, it will reduce the risk of, fights and disputes in future. Even a dispute mechanism can be provided upfront, that tomorrow if there are any disputes, we will refer to arbitration, and we need not go, first place only to the court and etc. Negotiation tool, as I was mentioning, all the major negotiations can happen at a term sheet level itself. Foundation, it lays the groundwork for drafting binding legal agreements. So that is very important. So tomorrow when you draft the actual binding legal agreements like SHA and SPA, this term sheet becomes the base. It becomes the basis on which these agreements are drafted, because all those points that will be covered in the term sheet, only those points are covered in the SHA. Of course, they are elaborated, a complete procedure is mentioned, and it is just an elaboration of your term sheet. SHA or SPA is nothing but just an elaboration of your term sheet. So now I'll take you through, important clauses in the term sheet. What I usually mention, important commercial clauses is first valuation. Valuation very important. You may not write exactly how many shares may be issued to you, but at what valuation you are investing in the company, at what valuation a investor is investing in the company, that is clearly mentioned in the term sheet, that the investor is investing so and so money at a valuation of so and so, at a so and so valuation, or he's investing so and so money for so and so percentage, certain percentage of ownership. So that is very important, because that is very critical, that how much he is investing and at what valuation or for how much stake. So that is clearly mentioned. That is important. That is the most important clause in the term sheet. Then investment structure, like in what instrument he wants to invest, that also becomes a topic of discussion, that what the investor prefers, whether or what the company is offering, whether it is offering straight away equity, or it is offering CCPs or preference shares, or any other convertible instruments like CCDs or convertible notes or iSafe notes or anything. So many instruments are there in the market. So that also can be decided and mentioned in the term sheet to avoid any kind of future confusion. And the company also can take steps accordingly, that if it is issuing equity or CCPs, it has to ensure that it has the limit of authorized capital, otherwise it has to increase the authorized capital. And if it is convertible notes, then he has to ensure that he is registered as a startup, and otherwise he cannot issue convertible notes. And if it is CCPs, CCDs or equity, valuation report has to be obtained, it has to be in place. So all those points have to be clearly, what in what mode or what instrument he is investing, that has to be clearly mentioned in the term sheet. Third, liquidation preference. So the investor usually prefers to have a liquidation preference over the founders or other equity shareholders. If he is a CCPs or CCD holder, then he is automatically getting a liquidation preference. So this clause, they want that it has to be specifically mentioned in the term sheet, that during any liquidation or sale event, they should be given priority over other shareholders. So that is liquidation preference. And then we have dividend rights, dividend or if it is a CCPs, then a dividend part may be attached to it. Sometimes it might be nominal, or sometimes so that has to be mentioned, that what is the dividend coupon. Or if it is CCDs, then they may have interest, nominal one, or if it is convertible notes, then a little higher one. So whatever it is, all those dividend or interest components have to be mentioned in the term sheet. And then board rights and composition. So this is again, if an investor is investing significant amount, or he's getting significant stake in the company, then he may even require a board seat, or he may require certain rights, that these matters, we say reserve matters, so that these matters cannot be taken up, or these resolutions cannot be passed without a special approval from the investor. That when a meeting is called, the investor has to be present and he has to approve. Only then reserved matters, like for sale or merger of a merger, amalgamation, or when you are raising future funds, or when you are appointing a KMP, or there is some strategic sale, you are selling off 100% of the shares of the company, or you are selling off a substantial asset of the company. Whatever the company is on that main asset, and that asset itself you are selling off to a third party. Then in such critical cases, the investor may put his right, that in such cases you have to take upfront approval from me for proceeding. So that thing also can be clearly mentioned in the term sheet. Investor safeguards, so there are some common rights which are widely used, like a right of first refusal for both investors, and not just investors and promoters. That tomorrow any minor shareholder or anybody wants to sell the shares, then the promoter may put this clause, that tomorrow if you want to sell the shares, if you are being offered a very minority stake, then you have to first offer to me, that you cannot sell my shares to a third party without my knowledge or my approval. So first a right has to be given to me, that to buy those shares. Only when I refuse to buy it, then you can sell it to the third party. So that is called as right of first refusal. So usually promoters put this right to ensure a control on their shareholding, on their shareholders. So that is right of first refusal. And then we have tag along right. Tag along right is basically for minority shareholders, which will help them in joining in sale initiated by a majority shareholders. Suppose tomorrow promoters are selling, say, good percentage of their shareholding, about 20%, 30%. In that case, the investors can request them that, when you are selling your shares, you proportionately sell my shares also along with you. Of course, it is they cannot force them, but they can only request. So that is the tag along right. Then we have a different version of tag along right, which is called as drag along right, where majority shareholders can compel the minority shareholders to participate in a sale. So that is nothing but when promoters have decided to sell off the entire company, and the new buyer wants to buy 100% of the shares of the company. In that scenario, the majority shareholders or the promoters can force the investors or minority shareholders that look, everybody has to sell the shares. Of course, the conditions and it cannot be derogatory. It has to be on same terms on which the promoter shares are being sold. Same pricing, everything has to be offered to the minority shareholders. Then anti-dilution protection. This has become very common these days. This helps in protecting investors from dilution in future fundraising. Like there are two ways to it. One is, preemptive right is given that when a company goes for future rounds of fundraising, at that time an investor is given an option that, look, if you want to maintain your shareholding percentage, then you can also participate in this new round and acquire shares so that your percentage, there is no dilution in your shareholding. And second is this Rache right. This is very dangerous for startups. To give a very brief on it, it is nothing but today I raise money from certain investors at a certain valuation, say 100 crores. So the investors insist on this right, which says that tomorrow, if you are raising money at a valuation less than what you have raised from me, then you have to compensate me by allotting the difference in the valuation, by allotting me shares to meet up to the difference. So like today I'm raising, there is certain percentage attached to it. Like today I'm raising funds at 100 crore valuation. Tomorrow if I raise money from somebody else at a 80 crore valuation, then the difference, what the investor should have got had the valuation been 80 crore, that many shares have to be additionally issued to him. So this provision, many investors are these days insisting on having this provision. Of course, see, these are all commercial calls. There is no hard and fast rule that you have to have all these clauses in your term sheet. Term sheet, there is no statutory regulation or governing term sheet. It can be as you like. These are the common things. What I'm saying is all common clauses that are being used in the market or in the term sheet. But when you are drafting your term sheet, you can retain what all clauses you want, and you can delete what all clauses you don't require. Founders and strategic considerations. There are some, like, founder vesting schedules. As I said, the founders can also, if he is a founder of a startup, then he can be issued ESOP. So that you can, when you are onboarding an investor, you can make it very clear that, these many options are reserved for allotting to founder, and this is its vesting period. Over a period of 5 years, so and so number of options will vest in my founder. So that also can be mentioned. Or if very rarely, but that investor insists that in future the founder also has to put in money in the company, so that also can be clear cut mentioned in the term sheet, that on future dates the founder has to invest so and so money, etc. Non-compete and non-solicitation. So this is basically, investors insist that the promoters full time is invested in the company for developing the company, and he doesn't go, after getting the money funding in the company, he doesn't go and start a new company with the same business and taking away the clients from this company itself. So they basically try to restrict the founder by putting this non-compete and non-solicitation clauses, saying that you cannot enter into similar business or same business for a period, till you are associated with this company. Or sometimes they may even put a restriction on number of years, that even after you exit from the company for a certain number of years, you cannot enter into the same kind of business. And non-solicitation is you cannot even solicit the employees or uh, people important in the business operations of the company, like the direct consultants who are involved in business operations, advisors, those people also you cannot solicit into your new business. So that is non-compete and non-solicitation. Then ESOP allocation, you can mention in your term sheet that so and so percentage, 5 to 10% or whatever, is separately set aside for our ESOP, for our employees under ESOP plan, and to make it very clear that may impact dilution in future. So that also is very clearly mentioned in the term sheet beforehand itself. Then strategic considerations, that balancing investor control with founder, of course very key things have to be mentioned. It cannot be like once the investors are there, the founder goes to them for each and every approval. The founder has to be given liberty and full control on the operations of the company, only for some major things, as I said, there's merger or sales happening, something that really affects the business of the company. Only for those things he has to approach the investor for its approval. Otherwise, he has to be given full liberty to carry on the day-to-day operations and take important decisions as are needed for the business of the company, growing the business of the company. So that also are sometimes clearly mentioned in the term sheet. Key takeaways for navigating term sheet. So some important points that has to be ensured before drafting a term sheet. You ensure that the term sheet aligns with both startup's vision and investor goals. So it has to be a win-win situation for both startup and the investor. It cannot be purely in favor of one party. There can be some considerations which are beneficial to the investor. There has to be some considerations that are beneficial for the startup. So in that way, a term sheet has to be drafted. Balance investor protections with founder control and long-term goals. Yeah. So investor has to be, protected for his investment by giving him proper, rights and controls and exit mechanisms or strategies. Whereas simultaneously, founder has to be given his liberty for operating the business. Negotiation, we have to use the term sheet as a tool to negotiate clear and reasonable terms. It cannot be something very unreasonable. And clarity, it has to, term sheets can ensure clarity in all clauses. Yeah, and this is just a repetition that a well-structured term sheet will help you in drafting a well shareholders agreement. So these were some of the important clauses in a term sheet. If you have any specific questions, I'd be happy to take.
So, Shilpa, in your experience, while whatever you have presented is more technical and the procedural, what do you think a startup founder should really look in for? So when he gets a term sheet from an investor, serious investor, what should be a clear no for a founder, a growth phase founder? In your experience, what is that one or two things that are non-negotiable that you recommend or you advocate the founders, because these are typically kind of it could be traps or could be in the hindsight. So these are the 2 or 3 things that you should definitely look in and you should negotiate with the investor.
So the first point that comes is valuation. The main thing is I see some term sheets where the investors actually exploit the founders, And the founders at such initial stage, when they have not even started the operations, they end up diluting so much at the very beginning that what will be left with you, because startup has too many stakeholders. You can't pay money in your initial stages, so you end up offering shares to everybody, to your investors, to your technical collaborators, to your advisors, and to all or any kind of stakeholders. You try to compensate everybody in shares. So you have to be very careful about the valuation, that what valuation you are seeking and what valuation the investor is ready to offer. It cannot be, you are seeking 100 crore valuation and the investor is ready to offer 50 crore, and it cannot be half of what you are seeking. 100 and the investor is offering 90, that can be managed, but 100 to 50 is a huge difference. I see many startups, in my experience, that just because they need money, they end up diluting so much stake that tomorrow you don't even have a 50% shareholding in the company. You yourself are 4 to 5 founders, and then you have so many other people whom you end up offering shares. Tomorrow if there is any dispute among the founders themselves, you have no say in the company. So you have to be very control, very, you have to ensure that you have control over the company. Your valuation and dilution, these are very important in the term sheet, that what valuation you are seeking and how much dilution you want to do, that has to align with your long term goals. And second important is your board seat. You cannot offer your board seat to somebody who is investing just 2%, 5%, 10%, unless required. Unless it is a very big round, you should not offer your board seat to the investor, because then it cannot be. Startups, they need to invest their time and energy on growing the business rather than more on compliances. They have to invest their time on growing the business. So the investors, they would some investors understand, but some investors do not understand, and startup may go through different stages in its life cycle. So you may not want that uninvited interference in every operation of your business. You can fix investor meetings. You can have in your term sheet that we will conduct investor meetings at so and so, half yearly, quarterly, or whatever it is, but never offer a board seat to the investors unless it is required. And of course, just see that some investors, they put restrictions on promoters to transfer shares. They put a specific clause that the promoter cannot transfer his shares, or his shares are locked in for so and so number of years, or till the investor is given an exit. So these clauses also are not so much in favor of the promoter. So these kind of basically what I mean to say is the clauses that affect your control over the company, or that affects your shareholding, or it gives dilution. So those clauses have to be carefully examined, and you have to say a no for those clauses. Two things a founder has to always put in mind: that he has control over the company, and his shareholding, he holds a majority stake in the company.
Yeah, thanks, Shilpa.
Yeah.
Any questions? There's a request in chat box saying, would you be able to share the presentation for future reference?
Sure, I'll share it.
Sure. Thank you. Anyone have any questions? You can just ask. You can also use the chat box if you can't unmute yourself.
Shilpa, you were saying about the founders losing out their own stake at certain point in time if they keep diluting. What would be the alternatives that they can look in? Because founders at the end of the day to run the show may require more money. So not to dilute, but get the money. what would be the better alternatives that you would suggest?
Sir, see, the promoters are also, if you are registered as a startup, as I said, promoters are also eligible for ESOP. So you also reserve a certain portion of shares for yourself, under ESOP, so that tomorrow you can exercise and you can increase your shareholding. I understand, the money is very critical, funding is very critical for startups. But if you can't, try to negotiate. But if you can't, then you also put in your clauses that, I will be granted so and so options on meeting certain milestones, or, on meeting performance milestones. Link it to performance so that the investor may also not hesitate. Then so that tomorrow, when your company is reaching that level, even you are getting certain shares. So that could be one way, yeah.
So I mean, like, there's a lot of buzz around differential voting rights or the convertibles. Okay, how would you convince the investor in granting maybe the higher voting rights to promoters, or in terms of not getting onto the equity table directly and getting into maybe convertibles, be it CCPS or CCDS or OCPS or OCDS, whatever the case. Okay, how do you generally convince the investor in such scenarios?
Sir, usually investors themselves, in my experience, have never been interested in getting direct equity. They've always been interested in getting CCPS, because preference shares, it gives them preference over equity, or mostly when you have foreign investors, or even within India also. People show interest in getting convertible instruments only more than direct equity. So I don't know if there is if there is any shareholder if there is any investor who wants to get direct equity and I have to convince him to get a convertible instrument, then first point that I will tell him is that liquidation, liquidation preference. That tomorrow, sir, if something goes wrong in the company, if you are an equity shareholder, you will be the last to be repaid. Whereas if you are a other kind of CCPs or CCD holder or other secured or unsecured creditor to the company, then you will be paid in preference to the equity shareholders. And then equity shareholders, they do not have any coupon. I mean, they don't have any dividend or interest rate attached to them. Whereas if you are holding CCD or any other kind of convertible notes, then there can be certain interest also, which the company may not pay as such, but that can be added to your principal amount and be eligible for conversion when the conversion happens in a future date. So, in these modes, maybe we can try to convince them.
Thank you.
Any more questions, please?
There's one more question, Sylvia. Give me a second.
Okay.
Okay. The thing is that I mean, like, generally there will be kind of companies which will be started either in India or outside India. Later on, there may be completely flipping of the structures because of the maybe the major investor requirement. For example, the company started in India, and I had to have my holding company in US because the investor, something like maybe Y Combinator or any other investor, said that you should have a holding company in US along with the intellectual property rights. In such scenario, how do you see that what you call flipping these structures entirely from India being holding to a US company becoming holding? Okay, how do you convince your stakeholders, especially the shareholders, to what do you call change their shareholding from the Indian company to US company? And there'll be FEMA regulations that would be coming into picture as well, right? So how do you get into these intricacies?
That's quite a task, sir. I mean, what you are asking is a very complicated thing. Somebody who is holding in India and then asking them to hold shares in US, it is a very difficult structure, because when FEMA, there will be FEMA, there will be LRS, ODI, so many charges will be applicable, and it's a very complicated structure. Uh, Maybe, I don't know how would I mean, I cannot. At the moment, I may not be able to suggest you the actual mode, But somehow, first, if we can convince our investor himself that, why to complicate the structure, because we may have lot of investors here in India itself. So to bring all of them into the US company, and probably they will not invest again in those shares. It will be maybe a swap of shares, that for the shares that they are holding in Indian company, they would be issued shares in the US company. It's a very difficult structure, and PEMA regulations will apply, and we have to convince a lot, and it is a time consuming and a hectic task. So as much as possible, we should avoid this kind of structures. And if it is not avoidable, then you have to take help of a proper consultant who can structure the whole transaction so that you don't face any issues, who can drive you through the entire process and help you in actual execution.
Got it. Thank you.
Yeah. I can share this presentation. So if you have any questions in future, my email ID is mentioned here. You can contact us if your company has a requirement for any kind of services from our company SimplyBiz. You can approach us anytime. We are basically, we try to cater to all the requirements that are applicable for a startup. We set up the business. We even offer corporate secretarial regular based compliances. We even do entity managed services like your bookkeeping, accounting, taxation, payroll. Those services also, which a small startup which has just started wants to outsource. So those services also we provide, and then we have a fundraising, M&A, contract drafting, reverse due diligence, ESOP vertical as well. So we provide all kind of services to the startup. If you have any requirement, you can approach us.
Thank you, Shilpa. Thank you for the session today. I hope everyone has cleared their doubts. If you have any questions, you can reach out to me. If you have any further questions, you can reach out to me. I will share the questions with Shilpa. Thank you so much for joining us today and giving everyone the clear explanation, the clear answers for their questions, and a wonderful session. Thank you, Shilpa.
Yeah, thank you. It was my pleasure to be a part of this session. I hope I was able to, at least inculcate a basic understanding on these topics. Yeah, all the best to everyone on their startup journey.
Thank you. And our next session is on AI buzzwords and ChatGPT 4.0. It's on 27th of August, 3 to 5 p.m. If there are any changes, I will let you know through the WhatsApp. Thank you. Thank you for joining the session today. If you want to share your feedback for the session, you can scan the QR code and you can give your feedback. Thank you. Thank you for joining us today.